Welcome to The Explainer, where we break down the complex topics using data right from the source. Today we are brewing up a pretty serious competition, pitting four coffee giants against each other in a Wall Street-style showdown.
So, who are we talking about? Well, we've got Starbucks, of course. Then there's Luckin Coffee, Dutch Bros, and Restaurant Brands. That's the company behind Tim Hortons. We're going to put them all head-to-head, really look at them through the eyes of a value investor, and see which company's stock is actually the strongest brew.
So here's how we're going to break it all down. First, we'll meet our contenders. Then, we'll get into the battle of the business models. After that, a full-on financial showdown. We'll look at their moats versus their red flags. And then, we'll wrap it all up with the final analyst's verdict. All right, let's jump right in and meet the four companies all fighting for that top spot. You'll see pretty quickly that each one has a totally unique flavor and a very different approach to winning your daily coffee money.
So here's our lineup. You've got Dutch Bros, the high-growth challenger that's all about speed and culture. Then there's Luckin Coffee, the tech disruptor from China. Restaurant Brands, which is this massive franchise behemoth. And of course, the premium global titan itself, Starbucks. But look at those analyst risk scores. What's kind of fascinating is that the two biggest household names, Starbucks and Dutch Bros, are actually rated as the highest risk.
So let's dig into that a little. How do these different identities actually shape their strategies? Because the way these companies operate is fundamentally different. And believe me, that has huge implications for them as an investment.
It really comes down to a classic split. On one side, you have Dutch Bros and Starbucks. They're what we call capital intensive. That just means they spend a ton of money building and leasing their own physical stores. But on the other side, you've got Luckin and Restaurant Brands, which are capital light. They use things like tech and franchising to grow super fast, basically letting other people pay for the new locations.
So let's break that down. Dutch Bros is all about the vibe, right? That energetic service you get at their drive-thrus. Luckin is basically a tech company that happens to sell coffee. It's all built around its mobile app for speed and convenience. QSRs? You can think of them as a landlord. They just collect these really stable, high-margin royalty checks. And then there's Starbucks, selling a whole premium experience, mixing their own stores with licensed ones and a really powerful digital loyalty program. Okay, time for the main event, the financials. This is where the story a company tells meets the cold, hard reality. Let's see whose business model is actually making the most money. But first, we got to talk about a really key metric, free cash flow, or FCF. Just think of it like this. It's the actual cash a company has left over after paying for absolutely everything it needs to run and to grow. It is the lifeblood of a healthy business.
Now, wow, look at this. The difference here is just massive. Luckin is an absolute cash-generating machine. We're talking nearly $6 billion in free cash flow. QSR is looking healthy too. But then you get to Dutch Bros, and they're at zero. And the biggest shocker of all, the giant Starbucks is actually burning through cash with a negative $1.4 billion. That's pretty stunning. So what does this tell us? It means that both the hot new challenger and the global titan are in this heavy reinvestment phase. They are spending every single dollar they make, and in the case of Starbucks, even more than that. Now, this is a really risky strategy that completely depends on future growth paying off big time.
All right, let's talk about debt. Look at Restaurant Brands. They are highly leveraged with debt over 3 times their equity. That's a lot. Dutch Bros is also carrying a pretty significant amount of debt. Luckin, on the other hand, is playing it much more conservatively. And Starbucks? Well, you can't even calculate the ratio because its equity is negative. That's something else. And this right here perfectly illustrates the risk we're talking about. For an investor, Starbucks having negative equity and QSR having that massive debt load, those are major red flags. These kinds of aggressive financial strategies can create huge problems, especially if the economy sours. So, with those financials in mind, what exactly protects these companies from their competition? What's their moat? And on the flip side, what are the biggest threats that could potentially sink them? So here you have two very different kinds of competitive advantages. Starbucks has what we'd call a wide moat, built on its incredibly powerful, iconic brand. People will pay more for that logo and the whole experience. Luckin's moat is much narrower. It's built on pure efficiency, its massive scale, its convenience, and its low prices. It's really a battle of emotion versus logic. Now, Dutch Bros probably has the weakest moat of the bunch. It's based entirely on that energetic culture, which is just incredibly hard to maintain as you expand to thousands of stores. QSR's moat is moderate. It relies on the global name recognition of brands like Tim Hortons, which gives it stability, sure, but not the kind of pricing power you see with a truly premium brand.
The big takeaway here is that not a single one of these companies is a sure thing, not even close. Starbucks is fighting falling profits and all that debt. Dutch Bros could be growing way too fast for its own good. QSR is getting weighed down by its own leverage and struggling franchisees. And Luckin, well, even with great financials, it still has to deal with brutal competition and, of course, the shadow of that past accounting scandal.
Okay, so we've looked at their business models, we've dug through their financials, and we've weighed their risks. So after all of that, what's the final call from this value investing analysis?
And here it is. The final scorecard is pretty decisive. The analysis says to avoid Starbucks, the financials are just deteriorating too much. It's a sell or avoid on Dutch Bros, basically saying its stock price is completely disconnected from reality. Restaurant Brands gets a hold or avoid because it's seen as a fully priced company with too much debt. And that leaves Luckin Coffee as a hold. It's the only one with a reasonable balance of growth and financial strength, though it's definitely not without its own set of risks.
So the thing to really take away from all this is that a famous brand you see on every street corner doesn't automatically make for a great investment. According to this analysis, the financials for 3 of these 4 companies just don't support the current stock prices.
And this final thought on Dutch Bros really just sums up the whole showdown perfectly. It's so easy to get swept up in an exciting growth story, but a smart investor has to separate that story from the cold, hard numbers. And in this great coffee war, it seems the financial reality tells a very, very different story than the one you might see on the menu.